Hello and welcome. For today's interaction, I'm joined by my colleague Chirag and Shridatta Bhandwaldar, Head of Equities at Canara Robeco Mutual Fund. He manages multiple schemes and over 70,000 crores in assets. Welcome, Shridatta.
Hey, hi Ruchira. Thanks for having us on the show.
Great to have you here. Now, to begin today's conversation, I want to know, you were an engineering student. What drew you to the financial markets?
Oh, it's naturally being from a middle class Maharashtrian family. I actually decided to pursue engineering because engineering and medical are two fields that typically most of the middle class income Marathi families tend to do with their kids. But when I was doing engineering, somehow after second year, it was not actually I was not getting enough interest in actually the technical part of it. So while I completed my engineering from a very good college, but then I decided to pursue the business administration after that. And so I joined for my MBA course in Mumbai at Sydenham Institute of Management for a MMS course. And when I was actually in MMS, initially you don't necessarily, while being engineer, I decided to choose finance over marketing. Uh, I was a avid reader always, and still I am. I used to read a lot, and Sydenham was a college which was allowing you to actually spend enough time in library, and it's a unique uh, MBA college which allows the students to not have compulsory lectures, but whatever you like, you can attend. The rest of the lectures you can actually, I mean, go sit in canteen or go sit in library. Generally used to sit in library, and I picked up, uh, started reading on financial history and financial books, and I picked up a lot of interest in basically both macroeconomics. So first I developed interest in macroeconomics, and then the markets, and that's where I decided to actually pursue career in basically in the equities. So actually it's not on my CV, but initially I joined a bank from campus, and I left it in 6 months and joined the brokerage firm where I started my career as an associate for equities.
So, what were your key learnings during that particular time when you were doing the sell side research?
Sure. So I think at that point in time during the sales side, the key learnings are very, very basic. They are not profound. You develop basically a refined or profound learnings over a period of time when you see market for 15, 20 years. That was a period of learning. And so were the actual learnings that you're asking for. So basic learning was how important financial modeling is. Actually, if you actually step back and think about it, uh, even without meeting a management, if you have the past numbers of a particular company and the entire financial model, both balance sheets and P&L, it tells you a lot about what kind of people you're dealing with, what kind of business you're dealing with, what kind of industry you're dealing with, how are the asset turns, the capital efficiency of the business. So I think if you ask me, the one thing that I learned in those 3, 4, 5 years is uh, basically the financial numbers uh, and its importance as an analyst, as a fund manager over a period of time, that it has in your basically day-to-day decision making. A lot of people actually tend to focus a lot more on narrative. While narratives work in near term, it's always the numbers which are details and which are the hard truths about the businesses, which tell you a lot about the underlying things that are happening in business. I think that was core learning because you ended up. So I was and fortunately or unfortunately, I was doing capital goods and infrastructure, which was the most happening sector at that point in time. Uh, so you got to learn, and right from, because we were just out of college, I had this fascination as to capital goods companies is okay. For example, uh, just a disclaimer: this is not a recommendation to buy or sell. I'm taking certain names, but this is just for explanation purpose. For example, BHEL, ABB, Siemens, and other companies, product companies, they're capital efficient. They were growing. People were paying higher multiples, so fine. But when I was covering on the other side, the EPC companies, and people were willing to pay 25, 30, 40 Ps on them in 2007-8, it fascinated me as to how a near-term thing in market can disproportionately impact the behaviors of even fund managers who are senior enough. It doesn't mean that I knew it and they didn't know it. Of course, they knew it, but they were actually still investing in those businesses because that part of the market was showing the P&L growth, which is basically it was just showing the income statement growth. There were no cash flows accompanied with it because you are running a working capital of 130, 140, 150, 160 days. That too depended on a lot of regulations and with government. So it was a huge risk in those businesses. So second learning that I had was, apart from importance of financial modeling and looking at numbers minutely and what they tell you, the second was basically on a in terms of businesses, they fall in buckets, and just because in market they are working or not working, it doesn't change the nature of underlying business. So stock price might go up in a particular year, even 100%, 200%. It doesn't tell you anything about the underlying business, and that business can still be dud, and it will be proven over 3-5 years that it was a dud business. That was the second learning because thankfully, I got to do two sectors who were within the same segment. One was capital goods, which were product companies, which were extremely capital efficient, relatively good managements. They were delivering cash flows. On the other hand, there were companies like EPC companies who were growing very fast, but they were not delivering any cash flows, and people were paying multiples to them also. So I think that was the second learning, that basically you don't focus so much on just P&L growth. You focus on whether that P&L growth is accompanied by capital efficiency or not. And thankfully for me, I was doing those sectors as a sell side guy or as an institutional research analyst. So you got to see it very, very closely in terms of what their true nature is. You got to meet the management. So and the third was again in line with that. Basically, a lot of businesses, based on whether they are B2B, B2C, who are their stakeholder, that defines what kind of promoters you encounter in those sectors. A company in B2C, mostly you might not encounter a troubled promoter because he's directly dealing with B2C. He has to earn their goodwill, which means the product quality has to be really good. He has to deal with the distributors fairly. He has to deal with everybody fairly. Whereas there are businesses where effectively the promoters are dealing with a lot of stakeholders where they might have to do a lot of stuff which is not necessarily in the interest of minority shareholder. Let me not blame them. Let me say that it is not in the interest of minority shareholder. So importance of who's actually in the driving seat and in which business he is sitting, that also becomes very, very critical, and which only tells you that particularly in a country like India, and now I'm actually using my experience over a period of time to tell that learning. At that point in time, of course, it was not that clear, is that the promoter, as a minority shareholder, you are completely dependent on the promoter or the management who's running the show. So they clearly have to be in the bucket where they are fair in terms of their inclination to share the interest or cash flows eventually with the minority shareholder. So those are the broadly three learnings that I had. Importance of basically the basic financial models, and how much you can learn just by looking at the financial models. Because ultimately, if you look at 5-year number, somebody can actually do a little bit of juggling with 1-year number, 6-month number, but you can't have 5-year number being juggled. So you get to see a lot better picture about the past of the company, because everybody comes here, since you are a capital allocator, everybody comes in market, he's asking for capital directly, indirectly, whether it is in primary market or secondary market. So he's always telling you about his future, how bright his future is. You have to look at his past first. Okay, and that numbers tell you a lot. So that's one. Second is about the quality of businesses and which bucket they fall into, whether they satisfy the basic capital efficiency needs of the minority shareholder or not. That is second. And third is basically the quality of guy who's running the show, with whom you are dealing, whether he has inclination to share with you or not. Those are three, I think, key learnings that I have. Of course, I have used a little bit of my experience over a bit of time to refine it in the way I told you, except the first part, which is financials and your ability to learn from them.
Right now, staying with that period, you began your career in equity research during the 2006 bull run. But then, going forward, you experienced 2008 global financial crisis. How was it in those days? What are your memories of those days? Are there any key main takeaways from those early years that?
I think 2 or 3. I think one clearly was how over optimistic all of us were, and more than us, probably the promoters were. That is, I think, distinct memory, because everybody got into that this fad that I want to be the largest, or I want to be among the largest player, or I want to be the global player. So right from the biggest corporates in India, everybody, right, left, center, they actually went and acquired companies. And now if you look with the benefit of hindsight bias, uh, and it was very evident immediately in 2011 probably, that most of these things have not worked. So that is one distinct memory I have, that collectively when market does well, when economy does well, how people give up on margin of safety, and how the capital allocation happens. I think that's the biggest learning, or biggest memory that I have at that, from that point in time. Right from, I mean, if you look at everything, I mean, people did something like Satyam happened at that point in time, because the stock was going up, so management decided to probably, in a way, fudge the numbers. You had most of the companies actually buying into a lot of hedging products, which eventually actually uh, people realized they had to actually pay a lot more than what they hedged for. So clearly, what I remember from that period was, of course, one was uh, the good cycle where consistently the numbers were good between 5 to 8, and earnings were getting upgraded, and everything was positive. Whatever number you would put, always actual numbers were ahead of that, which we have rarely seen after that. Okay. uh, but the most important was the outcome, where every promoter, most of the promoter, not every promoter, and most of the large corporates in India eventually decided to become too optimistic, almost went berserk, and started acquiring right, left, center global companies and anything and everything, which eventually went bad and resulted into sizable NPA cycle in the banking system. Uh, of course, we have hindsight bias, but I think that distinctly I remember. Of course, some of them, because I was also a capital goods and infrastructure analyst and utilities analyst, it was very evident to us. I mean, for example, it was almost impossible for so many power plants to get coal. While they were putting up coal plant, they did not have necessary coal supplies. And while they were getting the letters from the regulator or the ministry, uh, at least us as an analyst on ground knew that it is just not possible for Coal India to produce so much of coal for so many plants, which is what eventually actually ended up happening. So everybody was too optimistic in terms of the expectation. I think that distinctly was the learning from that. That when things go that optimistic, you have to start, at least now as a portfolio manager, start looking at your portfolio and say, okay, within your 40-50 businesses that you own, which are the weakest businesses, get out of them before the things turn bad, because they do turn bad time to time.
You mentioned over optimism in the markets in 2008. Going by the way the markets are today, the Indian markets, do you think the markets are over optimistic today?
I think that there are parts where clearly market is over enthusiastic, and not because we're likely to have the same outcomes, because I'll also tell you why it is not. I'll tell you why we think that it is over optimistic, and also why we are not as worried as, for example, in hindsight, at that point in time, of course, we did not know.
Right.
We are not as worried as, say, 2017, 18, or 2013, or 2007, 8. So clearly, mid cap, small caps, if I look at the 3-year earnings, 5-year earnings, uh, near term earnings have been a little higher. But if I look at 3-year earnings, their earnings growth has been just barely superior to basically large caps or top 100 companies in the country, whereas the valuations are already trading probably anywhere between probably 1 time to 2 times standard deviation higher than the historical averages. Does it mean that the market has to correct? No, it doesn't mean market has to correct tomorrow. It only tells you that your implied returns have fallen, or the earnings growth has to catch up, which means that part of the market has to really deliver superior earnings growth. My personal answer to both those questions is, or the second question is negative, that you're unlikely to have 25-30% earnings CAGR even in mid cap, small cap for next 2 years. Is more likely to be 15-17%. If that is the case, your implied returns have fallen, and that's where I said there is a exuberance in part of market. Of course, there are certain parts where there is too much of exuberance, where the business fundamentals themselves are under question, and people are willing to pay 30-40 PE or 50 PE to some of those businesses. Not because that 50 PE has a problem, the business is a problem in my view. in a lot of those cases. And as the time passes, people will realize that. As far as large cap space is concerned, we don't see any challenge because they're barely trading at a premium to their historical valuation. There is no extraordinary earnings expectations that is built in that part of the market. On top of that, it has received from a technical perspective the lowest amount of flows, both from domestic guys and FIA. So that part of the market, I think, relatively looks far safer, unless the earnings disappoint even from where they are expected on a consensus basis for top 100 companies. So that's one part of it. Now coming to the second part, why we don't think this time around you run the risk the way 2008 was or 13 was or 18 was, because your balance sheets are in a very different stage today from a corporate perspective. In 2008 9, by the time those crises started happening, everybody had levered up their balance sheets significantly, or was in the process of levering up balance sheets till 2010. Okay. In 2013, again, you were in a bad shape in terms of balance sheet. 2017, you are in a bad shape in terms of balance sheet. Today, when you look at corporate balance sheets and when you look at bank balance sheets, probably they are in a shape which is one of the best in last 15-20 years. You don't get permanent capital erosion in stock markets with this kind of balance sheet. That's my personal thesis. I don't know, it'll get tested now, but when you lose 50% or 100% or 70% when your balance sheets is a challenge. And I'm just randomly using those numbers. They have no sanctity in terms of any past data, so I have to give that disclosure. But the permanent capital erosion or significant capital erosion typically tends to happen when the balance sheets are challenged. For the earnings growth, you get penalized in terms of price correction to some degree, or time price correction, or both. My sense is probably we'll get both of them a little bit for next few quarters, and it will get adjusted because you have to adjust only the valuation. You don't have to adjust the balance sheets. When you have balance sheet challenges, then you get basically serious corrections in the market.
Coming back to the Canara Robeco Mutual Fund and the funds you manage, you co-manage and manage around 13 equity funds at the fund house. So just wanted to understand, how do you allocate the time to each of the fund, and what are the basically guidelines and thoughts of managing so many funds?
Sure. So I don't manage 13 fund directly on a day-to-day basis. Some of them I directly manage. Some of them I manage as a co-fund manager. The objective here at Canara Robeco is very simple in terms of having basically the two fund managers across all our funds, even the funds where I am the primary fund manager. We have two fund managers. The idea is very simple. That investor has nothing to do with whether he has invested in Canara Robeco or any other AMC. He should get the continuity of thought process. He should get the continuity of knowledge, the decision making that has happened in any fund. So when you have two fund managers, there is a continuity of decision making, and the other guy always knows what the primary fund manager is doing, and it is time to time discussed within reviews. It is discussed, so there is always continuity in terms of the decision making. So that's one. Second is, out of these 12-13 strategies, 4 strategies I directly manage, which is Canara Robeco Bluechip, Canara Robeco Flexi, Canara Robeco Multicap, and Canara Robeco Focus. These are the 4 strategies as of now, as on today, I directly manage. Of course, there were times when I was managing 5 schemes or 6 schemes, which have gradually, as the team has expanded, as the new fund managers have joined in, most of whom I believe are much smarter than me. I have actually given up some of my funds to them. So in those funds, my role is more basically one, as I said, the continuity of thought process, that you are not changing the styles, or you're not changing the strategies, or you're suddenly taking the U-turns, because investor has given money to Canara Robeco. He has not given it to Shridatta or X or Y or Z, correct? So he has bought into something. You should be true to label. Second, basically, my role is to ensure that there is not too much of risk taking, and that is more as a HOA rather than just co-fund manager, that there is not too much of risk taking, concentration or illiquidity that is coming in portfolio. Third, a review mechanism in terms of the portfolio outcomes, whether they are playing out or not. And I'm very proud that at Canara Robeco we never blame people that you've done well or not. We always look at, okay, this is what has happened, what is the learning out of it, and how can we correct it next time. So that's what the reviews are for. Reviews are not to to blame people, because everybody makes mistake. I make mistakes, they make mistake. It is a review mechanism where I take the reviews of all the portfolios, whereby uh, including outcomes, but outcomes are the last. More importantly, basically attributions, which are the stocks which have come in, which are the stocks which are going out, why they have gone out, if something has gone out and worked, why did it work, what was our thesis, what has come in, what is our thesis, and then finally the outcomes, what the outcome is, whether it is good, bad, ugly, great, whatever it is, we actually do that. And last is basically what is the learning out of this, and it happens every 2 months. What is the learning out of it, and how can we correct it? So those are the basically roles that I have in the rest of the funds. Also, lastly, in terms of wherever there is a nudging required, that okay, this portfolio seems like probably going too heavy on this sector as a house, or my research analyst is not so constructive, I am not so constructive, so nudging. But we never actually tell fund manager to trim it just because the analyst is saying or the fund manager is saying. Of course, because he can be right and we can be wrong, and we can be right and he can be wrong. So it's always nudging and sensitizing that okay, this is what is happening in this is observation in your portfolio. And lastly, basically, if there is any new name that is coming in, particularly or there is a complete exit, I discuss with the fund managers for 5-10 minutes on that idea as to why we are entering the name, why are we exiting the name. Of course, every name that you are entering or exiting is part of universe, so they are free to do that. But as a co-fund manager, I discuss it, and I discuss the same thing when I'm primary manager. I tend to discuss it with my co-fund manager that this is the reason I'm actually adding this, or this is the reason I'm exiting this. So that's basically, in a way, my role in the rest of the funds, which is checks and balances predominantly, risk management, checks and balances, and entry exits, ensuring that not a right or wrong, but I nudge them in terms of what my thought process is on those things, or what, or as a house, our view is on those things. For example, I'm just extending it. Suppose today our and this I'm hypothetical situation. This is not the true situation. My financial analyst suppose says no, I'm negative on the financials for next 1 year. And if most of the portfolios are underweight and one portfolio manager is running it overweight, of course he has a reason to run it, but we will have a discussion in terms of nudging that okay, this is the thought process, this is what analyst is saying, this is what my thought process is. If I concur, you should actually have a rethink on that. No, nothing beyond that, because ultimately the accountability and responsibilities of the lead fund manager in terms of outcome. So he should have all the freedom to actually take his decision, of course within the compliance, liquidity, risk requirements of the firm and strategy.
All right. Now, could you briefly describe your investment philosophy and your approach to equity management?
Oh, as a house, we have very basic, simple philosophy, which I actually started with effectively. That ultimately businesses create wealth, and the businesses which create wealth over a period of time, broadly, and I'm not saying all of them, broadly have the characteristics which are that one, they are scalable. Second, they are generally deliver product or service which the customer likes, and that allows them to actually have cash generation, and scalability is there, so that cash generation in a capital efficient manner, if it is happening, it allows them to compound that basically earnings, which is cash equivalent in my mind, for those businesses. Those are very simple characteristics that you need to have a capital efficient businesses which have the opportunity in terms of scalability to redeploy that cash, and you should have a promoter or the operating management which is going to do it in a prudent manner. If you have a combination of those few things over a period of time, generally those are the businesses which create a lot of wealth, because effectively they end up having products or services which allow them to actually have capital efficient outcomes. So so basically fundamentally the focus is on businesses and not so much on stocks, because in near term, like what you have probably observed in last 6-8 months also, uh, in a way, the market is displaying that every company in India is going to deliver supernormal outcomes. Okay, if you look back for last 10-20 years, not even 15% of the businesses actually sustain their numbers beyond even 2 years. Okay, and that's where this thought process to focus on number focus on basically businesses and promoters becomes very important. So that's the core thought process, that you focus on businesses, forget about stock, what is happening there, because market can remain fairly rational in near term, but over a period of time it becomes more and more rational. So if you extend the period beyond 1 2 3 year, you rarely will find businesses where the businesses have done badly but the stock have done really well. That's very rare. Okay, that's core. From there follows the investment broader philosophy, that we need to have basically broadly 2 or 3 things in place, uh, and you would have guessed that by now in last 15 minutes, that the quality of, we are public money managers, we can't be purists, but the quality of business has to be acceptable in terms of its characteristics, and those financial characteristics can be, and I'm not telling it in sequence, can be related to capital efficiency, ROE, ROCs through cycle. It can be related to incremental ROE, ROCs that are changing in sectors. It can be related to asset turn. The other way to say look at the same business thing is basically you just look at any business on Porter's 5 forces model. You know which business falls where. So as long as the businesses are acceptable as a public money manager and not beyond probably top 2 quartile in terms of quality of business, that's the business we focus on. Then comes the management. As I said, I mean, we just underappreciate how important the managements are, particularly in emerging markets, including India, where most of the businesses are run by promoters. You need to know both his intent and ability. And while it is not uh, explained in that way in our investment process, I'm actually using simplified form to explain it because we're in a conversation. The the ability of a management gets tested in P&L, that is income statement, and the intent of the management gets tested in balance sheet. So those are, and this has been converted into financial parameters. I'm actually reversed it. Actually, I simplified it and telling you the things around both these ability and intent. There are several financial parameters which we actually look at when we do analysis of any new company which is coming in universe. But ability is always to do with the execution ability of the management, how the company has done versus the peers in the industry, how the cost structure of the company is versus peer, how the company's incremental diversification has been against the peers, how the company has been able to evolve itself over a period of time, which is basically all to do with ability. You can have all the ability in the world, if you don't have intent, it's of no use actually. And that's where balance sheets become very, very critical. In balance sheets generally, and in annual reports, your basically intent gets tested. What kind of accounting practices you have, what kind of basically asset quality you have, what kind of business you are dealing with in terms of working capital cycle. I mean, in the same industry, if somebody has a 30-day working capital and if you have 90 days working capital, I clearly know that there is something wrong with basically the product or service of this company, why customer is not taking it. Correct. But P&L looks probably good. Then you have accounting practices, how the board is constituted, who is on the board, how are the independent directors, related party transactions, what are the related businesses where the promoters have their own other firms or not have them. So all these things actually tell you about the intent of the management. It's very, very critical in my view, because intent is of no use from a 1 year perspective, but intent is extremely critical when you take a 3 5 year view or start investing thousands of crores in businesses, because the guy whose intent is a problem, his P&L will collapse one fine day very, very quickly, and that we have seen in enough companies over the last 15 20 years. So this is basically the core thought process, which is one, focus on business, forget about stock, what is happening today. Second, basically what kind of management you are dealing with. Third, what kind of business you are dealing with. And fourth, valuation. Fortunately, unfortunately, I think in India, and by the way, India has been probably one of the market which has the highest multi-baggers in the world. So you have to deal with the valuation from more intrinsic perspective. You have to look at, most of the time you have to actually force yourself to look at what kind of longevity this business has, because typically you get the valuation multiples for two things. You get the valuation multiples for basically the near term earnings growth, and you get the valuation multiples for longevity of business and capital efficiency of the business. uh, if you have capital efficiency and if your business is going to grow for next 30 years 40 years, you're not going to get that business at 20p or 15p even, or 30p. So you have to pay up a little higher. But at the same time, being public money managers, we have to be sensitive to the fact that next 2 years earnings or 3 years are earnings also a little more homogeneous, because while I'm and we have been holding a lot of stocks for 10 years, we're investing for probably 3, 5, 10 years. It is broken into basically every year and every 2 years and every 3 years. So when you deal with valuations, not only relative valuations or cheapness or expensive valuation, but we focus a lot more on, again, the intrinsic nature of business, longevity of earnings growth, and capital efficiency of the business. So business management and valuation, these are the three critical parameters that as a thought process we focus on. uh, uh, we were agnostic to basically, as long as these basically, in terms of hygiene, in terms of quality of management and quality of business is actually satisfied, then it doesn't matter whether you are investing in a 10p stock or whether you are investing in a 50p stock. I would love to get all the businesses at 10p which are great businesses, but unfortunately that's a rare case that you see. Of course it happens time to time. For example, I mean, I can just give you one or two examples. Just in probably 10 years, just in last, probably after 2014 15, you have seen probably exchanges, you have seen the general insurance companies, then you have seen the chemical companies, then you have seen the basically your cable companies. Most of them were available much cheaper, so they were available at a 15p or 20p, and now they have become 30 40p. But that's generally relatively difficult in a market which is so over researched as far as India is concerned. So you have to fight for it, and you have to be sometimes a little contra if you really want to get into a 10p or 5p stocks, because most of the time, 90% of the time, basically a lot of them are basically challenge businesses rather than great businesses or businesses which you can hold on, because it's not about the cheaper business will not do well in a 6 months period or a year's period. The problem with that is the biggest risk which most of the people underappreciate is, or rather two biggest risks that investment business has, is one is reinvestment risk. That I invested 100 crore rupees, it became 130 crore rupees. Now I want to sell it and again buy it. I'm assuming that my reinvestment decision will always go right, and the more I do it, the more is the probability that I'll go wrong, because I'll make multitudes of decisions, particularly in a year. Second is basically the risk of capital erosion. When you deal with businesses which are challenged, and if you end up dealing with them in a bad phase of market, because currently it's bull phase, so everything looks like every business is going to do well. But when you end up holding it at the end of the bull markets, or towards in the bear markets, you get permanent capital erosion which never gets recovered, because effectively most of the time 50% down, 30%, 40% down, you realize that okay, you're holding dirt, so you end up selling it, so you book those basically losses. So in equity business, volatility is never a risk, it's a permanent capital loss which is a risk, and that's what I worry about. So these are the two risks that come associated with a lot of businesses which are relatively cheap. But we're agnostic. When we look at the businesses, we typically look at, like what I said about the expensive stocks also, we look at what is the incremental capital efficiency and what is the incremental earnings growth over a medium term and over near term, means next 2 3 years. A combination of that, you try to make a decision in terms of portfolio construction.
There is one of a leading private sector bank which you hold across, which is a top holding across all your funds. So what's the rationale behind holding such stocks, and when the stocks become a compelling buy in your portfolio?
So it is already a compelling buy. Lot of the things that are happening. Of course, there was a corporate event, and to that extent, it has been impacted. But as I said at the start, and we're true to that level. Basically, we're focused on, is company growing its earnings at 15%, 13 to 15% CAGR? If the company is doing that, its time will come. Of course, tactically you could have reduced and you could have added back, and some of the times we do that, some of the times we fail to do that. But generally, you're focused on, in terms of, since you asked about a particular script, is the investment argument broken completely? Is there something in terms of competitive intensity in that sector which has completely changed? Is there anything in terms of the nature of business that has changed? Is there anything in terms of the quality of business management that has changed in those businesses? And then on top of that, is it significantly underperforming in terms of near-term earnings growth? If the answer to these questions is not affirmative, then you don't want to actually necessarily trim it, because we were not probably smart enough to trim it 3 years back or 2 years back. Then there is no point trimming it now, because it's compelling buy today at a valuation where it is trading for the earnings growth near term and medium term that it is likely to display. And that's the way we think about most of the things. As far as compelling buy is concerned, as I said, the most compelling stories are businesses where you identify them relatively at a stage where the profit pool of the industry is small, and at the same time that industry offers a inherent size, whether it is domestic or global size, which is very very large, and and you can identify basically one or two players who are likely to be the biggest participants in that profit pool. For example, and I'll give you a live example in our portfolio, because you quoted one thing where we have failed, so let me quote where we have succeeded. So hospitals is something that we never owned, probably between, I think, I don't remember owning it ever in last 10 years. Okay, in 2021, we decided to got into hospitals and hotels both actually. The reason was very, very simple. Exactly what I told you. The profit pools of these industries are very large. They're getting organized. They're getting asset light relatively. They are getting into a phase where incremental ROCs are double of their existing ROCs, or were double of their existing ROCs. And now I have one or two players in each of these industries which are likely to be the biggest participants in that profit pool. And lastly, has it started delivering in near-term numbers? The moment it started delivering in near-term numbers, that's when we got into some of these businesses. We are among probably top 3-4 shareholders in some of these companies, and not that the outcomes have been really good. The outcomes are accompanied by the profit growth. The profit growth for most of these businesses has been upwards of 25-30% over last 2.5 years, 3 years. So that those are the businesses which are most compelling. Of course, you get a lot of opportunities which are okay. I can get 2 years numbers, 1 year number, but then I know I run the, as I said earlier also, then you run the reinvestment risk, because 20% up, you have to again sell it and hope that I'll make an incremental decision, which will again be right. Sometimes it will be right, sometimes it will be wrong. Of course, we try to ensure that probably at least 65%, 70% of our basically incremental decision making is right. But that's what you have to cope with, and that's where if you get stories where the profit pools are likely to expand over a period of time, and you also know that okay, these are the 2 or 3 players who would be the biggest contributor to that, then you make those are the most compelling stories, because then you get, for example, you get locked in 200, 500,000 crore rupees, and you don't have to worry except looking at the details whether this is playing out for 3 years or not, in terms of quarterly numbers and interactions with the management. Although of course you have to do all that maintenance, but it becomes far more structural, and it avoids that reinvestment risk for 3 years, 5 years from that part of the capital.
What type of stocks or sectors do you generally avoid?
Of course, what we avoid is very, very evident from our thought process, that any promoter of a business where we think that they are quartile 3 or quartile 4 businesses or promoters in terms of their financial characteristics, their past track record, capital efficiency, that we tend to avoid. In terms of sectors, typically, rather than avoid, let me say that we are not very good at commodities. Let me be very, very frank that a lot of times I don't understand personally, and as a team also probably we are not so good at basically picking the commodity nature of businesses or commodity stocks. I think that's one space where generally we are not so good at in terms of participation. It also reflects the time to time when they outperform, we tend to get hit or we suffer during those phases. So that's one space I think clearly commodity natures is something that we are relatively weak at.
Shridatta, the performance of your largest funds have dipped after 2021. Can you explain the reason behind this fall in the returns, and what is the strategy to improve the performance going forward?
Sure. So let me correct it. So performance has actually dipped after mid of calendar year 22, and it has predominantly because of 2-3 reasons, and that you would have guessed by now. Clearly we have a little bit of more tilt towards growth quality versus value, and I'm just using those terms because investors understand these terms very easily. It, that's one. So the style that is predominantly in vogue today, we have relatively lower allocation in that side. That's one. Second has been the basically the impact of basically under allocation in PSUs and a lot of segments where tier 2, tier 3 names, be it NBFCs, be it tier 2, tier 3 PSUs, be it basically the tier 2, tier 3 small cap names which have done disproportionately well in near term, those were under allocated. So those are predominantly the two reasons. One is, of course, you are under allocated in terms of value, and second, you are under allocated in terms of some of these themes where people are too excited about. We have not been able to convince ourselves to have the same allocation as the averages, and I think that's predominant part of the impact that we have taken. When we look forward clearly, and we are not changing this in last probably 10 years, we're not changing it now. We are very confident that ultimately, as I said at the start also, if you're owning businesses where over a period of time compounding happens, these are all relative performances, correct? So on a relative basis, when the market context moves, your rankings can also move very, very fast. But we are focused on basically how do we find out more and more individual stock winners within our area of strength, which is where the businesses are acceptable, where the managements are acceptable, and we see that those profit pools are likely to expand. And that we already started seeing in some of our portfolios. Those outcomes have started playing out, be it Focus, be it Flexi, yet not fully visible in all the portfolios. But my hope is this for and we have not changed this thought process. For every problem in the portfolios, the solution is always stock selection, and stock selection always is a function of the predominant tilt of investment strategy thought process that the portfolio manager's house has. There is no point trying to go and play in somebody else's field and try to actually allocate disproportionately there, because you are not convinced about that, and that's where you did not allocate it. So we're trying to actually strengthen the selection within basically in a way where we think that we have right to win and bring the performances back. And I'm pretty confident that it has happened in the past, because this is not the first time I've seen this in the portfolio that you are talking about. This is the third time I'm seeing it in 10 years. It will come back. In fact, I would go one step further and say to investors that it is just like you should buy a good business in bad time. You should buy basically our scheme if it is underperforming during bad phase, because the compounding will happen at above average rate on a 3-5 year rolling basis. So that's how we are looking at the near term weakness that has come in the some of these schemes.
Here you spoke about the froth in the mid cap and the small cap space. So just on that backdrop, do you at this point of time, in particular the small cap segment, do you see the froth, and how does it affect your investment strategy while managing this small cap side of the market?
Sure. So let me put additional, not caveat, but additional thought process, because a lot of times when we use such strong words, it can have different connotation. Yes, there is froth in certain parts, and there are opportunities also in certain parts. So see, for stock selection, there is always opportunity. Good market, bad market, bullish market, bearish market. Every year there are 10 stocks which double, triple. Okay, so there are always opportunities. So those opportunities are there. Yes, generically saying, there is a little bit more exuberance, as I said earlier, also in some of these parts, and that is, of course, that is in my view, that is to some degree is forcing. If you look at the small cap, mid cap strategies across the board, cash and large cap have started going up in last 3, 4, 5 months, which is largely consensus, I think, across the market, that even within our small cap, we are doing the same thing for last 6, 8 months gradually, to avoid any concentration, to avoid liquidity challenges, and to take care of the opportunities that come invariably eventually. We have increased large cap plus cash position, which can be redeployed back as and when the opportunities come back in the spaces where you want to deploy. Of course, there are a lot of stocks which are going up today also, but you don't necessarily want to participate in some of them because you are not convinced that the valuation multiples for the kind of businesses and kind of promoters that they are enjoying are sustainable. Although I must say that this time around it has sustained for a little longer time than most of the times in last 15 years. But that's the one thing that we're deploying. And second is, as I said earlier also, even within small cap, we are focusing on how do you ensure that there are, see, within small cap also, there are pockets, and I can generically state the pockets. Chemicals is there, consumer durables is there, consumer staples is there, you have textiles, you have several pockets where while the market is in bullish phase, in those pockets nothing has happened. So you keep evaluating whether is there any pocket within those market caps where the things have not played out, where the margin of safety is far higher. Is there something that is changing in terms of opportunity from a selection perspective? So that's what you tend. That's what you're doing today in terms of even small cap.
Right, and moving on to the large caps where generating alpha is challenging. What's your approach to outperforming the index in your blue chip fund?
So outperformance, index again. I mean, in large cap, it becomes even more pertinent in terms of selection. What your selection is within those 100 stocks, because it is fairly tight category. Second is, what I observed is that people focus too much on basically large caps in terms of outperformance against index as a category. If you probably take up data today, I think mid cap, small cap, large cap, all are underperforming the benchmarks as a category, 1, 3, 5 year. It's always a phase. See, statistics is such a beautiful thing that you can pick up a statistic at one point in time and you can prove something. If you had picked up the same statistic 2 years back, you would have proved something else. So rather than getting into a lot of these things, what people should focus on, what is my risk adjusted return that a particular scheme is delivering. uh, for example, when you look at Canara Robeco Bluechip, okay, and I keep emphasizing on this point, okay, on 5 year basis, we are still matching or outperforming despite our growth quality style has been little out of favor for last 1.5 year. Okay, on 5 year ruling basis, we are still outperforming the benchmarks, okay, and most of the PS. Having said that, that is not more important. More important is what are the internals of the fund, okay, what is the churn of the fund, what is the beta of the fund, what is the standard deviation of the fund, and all these parameters, we are lower than the index by 15-20%, which means you're taking a much lower risk even than the index in terms of the risk that you are taking, and you're still getting the same returns. You should be happy with those returns because you're coming in that category for a particular set of returns. You're not coming there to take a higher volatility and expecting a very very high return as you should expect as you go into volatile or little broader market. That's one way to look at it. Second is, of course, in terms of alpha creation, the Canara Robeco Bluechip is one of the very few schemes which are still beating on 5 year basis. There is no other basically way to beat the index except basically both selection and deselection. In fact, deselection also becomes very very critical in this category because it's very very tight category. Again, as I said, I mean, so you have, if there's something is there in index of 3%, and if you can actually develop a conviction that okay, I want to own only 1% or I don't want to own it, that itself can add to 100 basis point. And in this category, 100 basis point is also very critical. So those are the two things that you deploy. But ultimately, for us, I mean, as a house also, and even in this scheme, or for me as a portfolio manager, while you look at allocation, you look at sectoral weights, while you look at top down, you look at the macros, but ultimately you make money in stocks. The differentiated view, the more differentiated view you get through 3-5 years on stocks, the higher is the likelihood that you'll outperform. And still, you might not, because we are in a business where we operate in external environments. There are a lot of things which can go wrong, which you did not think of. But nonetheless, that's what you can do. That's what we're trying to do.
Finally, coming to the one of the specific funds, in your flexi-cap fund, you usually maintain about 70 to 75% in large cap stocks and around 20-25% in mid cap stocks. However, your portfolio has recently become more conservative. So, what prompted you this change in this portfolio?
Exactly the thing that I'm telling you, that we find that opportunities, it's not top down. although we have been largely maintaining the mix of 75-25, and a lot of people have debate on this also. I think every product has its utilization. Okay, some products people come for particular risk, volatility, returning, basically parameters, and every product has its own these three parameters. Unfortunately, what happens is both during bullish phases and bearish phases, people try to take parameters of one scheme and try to apply it to other, which is, I think, is a little what I would say is a unfortunate thing that people do. But Flexi, if you look at as a strategy, why multicap was actually carved out of Flexi is for the same reason that Flexi has a BSE 500 index. It has 75-77% basically large caps. Okay, while it has flexibility, the product has been generally given to investors as a relatively conservative product. Which has 70% large caps and 30% probably mid cap, small cap, and cash. Okay, it has not been sold as a product which is aggressive. Whereas if the investor has to buy aggressive product, I have multi-cap, I have large plus mid, I have mid-cap and small cap, correct? So why should I deploy the same strategy in Flexi? Although one can deploy and some of the people do deploy, we have largely been consistent if you look at through I think last 8-9 years since I'm managing the portfolio, same portfolio, 8 years. It has remained in that band of probably 68% to 69% to 75-76%. Lately, it has become even more conservative because we think that the opportunities are relatively more to make probably 15-20% in large caps over next 1 year rather than mid cap, small cap. Not to say that we will not add mid cap or small cap, but it will be on a selection basis, unlike last year where it was far more broad based.
All right. Time for us to wrap up this chat. Thank you so much for joining us and taking the time for this interaction. We really enjoyed this chat. Thanks.
Thank you, Ruchira. Thank you, Chirag.
Thank you.
It was a nice conversation.